Let's bring in now CNBC contributor Adam Parker of Trivariate Research back here post night. Good to see you.
Thanks for having me.
Have you moved on from all this? How fixated are you on what's actually taking place on trade?
I mean, this week I've gotten 0 questions from institutional investors so far.
Not a single one?
No. Probably done 7 or 8 Zooms, a couple in-person meetings, and I had a big dinner last night with 8 big investors that didn't really come up.
Does that tell you that we're desensitized to it, or we've just decided that this is all going to play out in its own time frame and we're going to move on to bigger and better?
It's funny. So at this dinner last night, these are chief risk officers of major firms, institutions, and I kind of said, look, like nobody's worried about tariffs. Like, is it all we're worried about in April, and even those of us that were staunchly worried aren't worried anymore? And like, is that the moment of complacency? Because that could be the risk. And I think a lot of people just said, look, like we've spent a lot of time doing the math, and we think we can identify the securities, and we just don't think it's as big as a risk as we used to. So it could be complacent, but I think more the price in the market is generally telling you that it's probably going to impact the S&P earnings less than people thought.
The less of a bad outcome is like what the sum of all this sounds like it is, according to your conversations.
I think that's right. I think the biggest risk is probably still the China part, which was always the biggest risk. And to the extent that, we see that quote, they have a good relationship and all that, to the extent that people think that's not going in a negative direction, I don't think we're going to get a huge growth scare out of the tariff stuff with what I know right now.
Okay, so let's talk about what some suggest are the risks, okay?
Yeah.
Jonathan Krinsky of BTIG says the clock is ticking for a shakeout. In other words, we've run a lot. Wolf Research today says this marks the seasonal peak for equities. In other words, seasonals are going to get tougher from here. Goldman Sachs today says equity valuations remain quite high. So we're higher than the 10-year historical average. We're 22.5, and the 10-year historical average is like 18.6. You put all those three together, what do you come out with?
No information. I learned nothing from hearing that.
You're not worried about any of that?
We run
a lot. Seasonals get worse, and stocks are expensive.
Let's go in order, okay? Costin said there'd be 3% S&P appreciation per year for the next 10 years, and we got that we got the whole 30% since he said that. So I don't know why I'd listen to him. That's one. 2, because I'm not saying I could do it. That's an impossible task. Okay, earnings are less impaired than people thought. The consensus numbers are coming up since the trough. Okay, so I raised my numbers. I think the earnings are coming up. Okay. Valuations, I wrote a big note on Sunday. I know you saw it. It's just not the way you pick securities, right? Like cheap stocks don't outperform expensive stocks.
Nobody's saying
that the reason the market's more expensive is it's better. The market's better than it was.
But do you ever look at the fact and say, well, given the unknowns that still exist, I mean, the economy's not roaring.
Do I
Is it?
Yeah, no. I mean, no, but
and we've come a lot, and the market is more expensive relative to where it was.
As it was on Jan 124 after it went up 25%, and then it went up another 25%. As it was, I think it's always like a question of what do you think the changes to perception about growth are going to be? What do you think the changes to perception about rates are going to be? And do you think that skews to the positive? I think it does, because we're in this sort of innocent until proven guilty mode about AI productivity that hits earnings. It's cheap to say seasonals. That's the part I get that gets me a little more lathered up than normal. It's like, come on, go evaluate 100 years S&P returns. Tell me September is statistically significantly worse than others. Yeah, like a bunch of wars and other stuff in there. Like that's just spurious.
You dumped on Costin. I dumped on Wolf. What did you leave for Krinsky?
What did you leave for him? I don't know who the person at Wolf who said it is.
Well, you just blanketed the whole firm.
No, you said Wolf Research. I know Eddie's a great guy. I'm just saying he's built a great business. Who said that? I don't know. I don't know who Krinsky is. And Costin, I'm just saying he's been valuation sensitive the whole way up, and we know valuation isn't a predictor of subsequent return. I think valuation works in years 5 through 10, not in years 0 through 5. So you can sit there and be wrong for 5 years using valuation as an argument. That's my point.